Good afternoon, everyone. I am Abha Bhattarai, the economics correspondent at the Washington Post. As we all know, there is far more demand for affordable housing than there is supply. This is an ongoing problem, and there's an urgent need to find ways to finance affordable housing, whether that's through developments or preserving existing options. I am so pleased to moderate this panel this afternoon. We will be talking about not only financing such projects, but also how we can improve policies and programs to address the housing affordability crisis. With me here today are three leaders in affordable housing. Ismael Guerrero is the president and CEO of Mercy Housing. Mercy Housing is one of the nation's largest nonprofit affordable housing organizations. It owns and manages thousands of units across 20 states and has its own financial institution with a loan portfolio of more than $100 million. Next, we have Thomas Bryan, Executive Director and CEO of the Colorado Housing and Finance Authority. He has helped more than 150,000 people across the state become homeowners in that position. And third, we have Barry Krinsky, National Production Manager at Citi Community Capital. He leads a team that finances multifamily affordable housing using low-income housing tax credits and a mix of tax-exempt and taxable loans. We will take a few audience questions towards the end of this discussion. If you are joining us in person, you can submit a question using the QR code in your program. And if you are watching online, you'll find the submission link on the YouTube chat. Thank you all for being here today, and let's get started. Barry, I'd like to start with you. Citi Community Capital helps finance multifamily affordable housing in a number of ways. You use low-income housing tax credits, tax-exempt bonds, and use your relationships with Fannie Mae and Freddie Mac. What are some of the challenges you've been facing lately in this current climate?
Yeah, thank you for the question. We are living in interesting times for sure, and some of the challenges I think start from what can work and what doesn't work. And the deals that we're working on, I would tell you, all of them are tight. And what does tight mean? It means that there's not enough sources of funding to pay for the uses. And so how do you make that work? And to just give a little bit of an overview, if you were building a market rate property, and frankly building any kind of property, you really need two things. You need equity dollars and you need debt. And the combination of the two comes together and you build the property with it. And in a conventional deal, an investor needs to make a return on that equity dollar, and you got to be able to pay your mortgage. In an affordable deal, your rents are lower than in the conventional deal. And in order to support a loan, and you really can't support the equity that you can't support a market rate equity return. And so what the low-income housing tax credit program does is it allows institutional investors to get a tax credit at a reasonable return, but not a market rate return. And that is the return they're getting. They're not assuming a return from the cash flow on the property. We at Citi are very focused on financing those tax-exempt finance properties that come with those 4% as of right tax credits. And what we like to do is provide kind of the full life cycle of the lending. We provide construction financing to get it built, and then we provide long-term financing so that the property has financing for the next 15 years after the construction period. And that's important because the investors who buy the tax credits are taking that tax credit over 10 years, and they want to have a locked rate of interest. So some of the things that we can do to help make deals work in an interest rate environment that is a bit volatile, rates are changing daily, up, down. We try to work with our sponsors to give them the ability to lock into rates at a time when it makes sense for the deal. That can really help a deal get more loan proceeds that they need. it can take volatility off the table. That's one way that we work together with our developer clients to manage some of the risk.
Fantastic. Ismael, as Barry mentioned, financing is a challenge. It can be complex and difficult. What are the biggest difficulties you're seeing in the communities that Mercy Housing serves?
Sure, thank you. Hello, everybody. It's good to be with you this afternoon. Great to see so much interest and the people in the room, a lot of friends and friendly faces too, so look forward to hearing your ideas as well. I would say from Mercy's perspective, as we work across the country, so not state-specific, but really, what we see in multiple states in many ways. Sort of the challenges, particularly for underwriting purposes, I see fall into sort of three categories. There's a cost challenge, the complexity, and the entitlement process, right? And all those really impact our ability to deliver more units quicker and cheaper. The cost, we've seen the last several years with inflation, with supply chain issues. Now we're looking at tariff impacts. It's really increasing the cost to build in many ways. Labor, materials, and delivery times all really impact our times. And then we have now, since the last several years as well, the challenge of the cost of operating and managing the properties, right? We've seen interest rates rise, we've seen inflation, we've seen the cost of insurance, and labor costs, security, and so forth. So all of those, the more expensive it is to operate the property, obviously, the less cash flow there is to support debt, which means the bigger the gap that we need to fill through other creative means. So that's the cost side. The complexity is, and this will be a recurring theme, we have to apply for the tax credits, and if we get those, that's great. Usually we celebrate, but that's only about 60% of the total development cost. So then we have to go out and chase the home dollars, the CDBG money. You have to chase the Federal Home Loan Bank. Hopefully your state has a state housing trust fund. Your city has a mill levy that supports affordable housing. So you start layering all those financing sources, and not only are they all competitive, but none of them are on the same schedule, right? So it can take you years to line up all those commitments that you need, so that your construction lender feels confident in closing and starting construction. And then you have the entitlements process, which we all know, right? Not only land assembly and zoning, which can take a long time, but then you run into the NIMBYs in the area that may oppose your project, and the numerous voluminous community meetings you host in order to explain and to convince neighbors and other partners that it's important. It's in their self-interest and their best interest to add affordable housing to the neighborhood, to your city, to the community. So all those things, when you start stacking all that up together, it makes it really challenging to underwrite. It's why it takes 3 to 5 years sometimes to get a deal from concept to construction start.
Wow. Has that 3 to 5 time period gotten bigger lately?
It has gotten longer, for sure. Yep.
Thomas, what are you seeing in Colorado? Where are the biggest gaps in financing that you're seeing there across the state?
Yeah, thank you. I always have to start off with a question. So I have a question for the audience. What happens when a banker, a developer, and an affordable housing finance professional walk into a bar? I don't know. We're going to find out, because right after this, we're going to grab drinks. If you want to come with us, feel free.
The banker buys the drinks.
Right.
Is that the banker's paying?
I'm gonna start off by speaking to some of the issues we're facing on the home ownership side. We've heard a lot about multifamily development, but it's no news that Colorado is a great place to live. People want to live there. You want to come and enjoy our 300 days of sun every year. A lot of people have moved to the state of Colorado. With that brings challenges. In this case, we've severely underbuilt to house those individuals that have come to the state of Colorado, to the tune of about 100,000 units short in our state. So what happens, that pushes the prices of homes up. And so with the prices of homes going up, purchase price goes up, property taxes go up. We also have the 4th highest insurance premium hike in the nation. So being a homeowner in Colorado, I just got my insurance premium renewal. Anyone from Allstate here? Yeah, 48% increase in my premium. And I got off easy. There's a lot of people it's been a lot higher. You pair that with higher interest rates. If I were to buy a home, if I compare buying a home 3 years ago versus today, it's going to cost, my costs have gone up 71%. So principal, interest, taxes, and insurance. If you're buying a house today versus 3 years ago, it's going to cost you 71% more. Meanwhile, incomes have only gone up about 15% statewide in that time frame. So it's hard to buy a home in the state of Colorado. On the multifamily side, very similar thing. Development costs are skyrocketing. Pair that with program overlays. So to your point, there are gaps in financing. Developers go to their local community to say, hey, can you come in and fill those gaps? Community's like, yes, but we want X, Y, and Z. So that adds cost. And then just lack of skilled labor. We've seen the trades, finding skilled labor in the trades is very hard to do, so that's increasing costs. I'm not a defeatist, so yeah, those are the problems, but I like solutions, so I want to talk just real quickly on like what are some of the tools we're using to fix some of that. So generally speaking, housing finance agencies, we have the ability to go out and issue tax-exempt bonds to fund affordable housing. That tax-exempt borrowing capacity we have generally comes with a lower cost of debt, which is great, but we're limited on how much we can do that because mortgage revenue bonds or multifamily development bonds are capped based upon how much volume cap, private activity bond volume cap we have. So if anybody's looking for a fix there, I would recommend we remove housing from private activity bond calculation. That'll fix some of the problem. But so we can issue tax exempt, but we're limited on how much we can do that. So we're trying to be flexible with that resource. We issue taxable and tax exempt debt. We blend those together. We pair in fixed rate with some variable rate debt. We know there's some variable rate risk exposure there. So as a finance agency, what we're doing is we're entering to derivative instruments in the form of interest rate swaps to make sure that we're hedged appropriately. But what all that does is help bring that cost of capital down a little bit. That lower cost of capital then allows us to lower our interest rates to ultimately the borrower, so who we end up lending to, which is important. So that's one side of the interest rate. If you talk with some of our partners in the state, I'm thinking Habitat for Humanity, Metro Denver, and Elevations Community Land Trust, partners who are trying to build for sale affordable homes available, at a price point that's, let's say, $400,000 or less. $400,000 or less, nobody's building in that range in Colorado, so the fact that they're trying to build in that range, we've partnered with them and have gone to our state. I'm saying we partner with the state. I don't know that our state treasurer is really excited about this. But what we did is we got the state legislature to pass legislation that allows the state treasurer to invest in high-rated, AAA-rated housing bonds at a below-market rate. When I say below-market rate, we're targeting 3% right now. So now I have the ability to go out and issue 3% taxable bonds that are AAA-rated that our state treasurer is going to purchase, and then I can take those bond proceeds and use them, one, to incentivize construction in the state, so single-family construction at an affordable price point. We then turn right around and use that capital to lend to the first-time home buyer that's going to be in that home. So in this case, 3% mortgage, 3% construction funding. So that's one of the ways we're trying to leverage state resources in a time where state resources are strapped. We have a budget deficit. What we're asking the state to do is say, okay, forego about $1 million in interest revenue, and that will allow us to leverage $50 million in investment in the state. So they took us up on that challenge, and we're getting ready to roll that out. Yeah.
Wow. So we've all touched on this a little bit, but I'd like to open up the next question to the whole group. We are in this post-pandemic landscape where, we're facing elevated construction costs, interest rates are higher, there's so much uncertainty across the economy. How are you dealing with that? How have you had to adapt to that? Just walk us through the last few years.
Sure. I'll start on that one. I would say what we're experiencing at Mercy Housing is what many of our peers, many of you maybe are experiencing as well, it's been a really a detrimental, disruptive impact to the portfolio, properties and portfolios overall. And it's shown up in a couple of ways. In terms of rents, right? The challenge of rents being flat or decreasing, and then rent collections have been a challenge. So your revenues, is flat, if not declining. At the same time, in the same moment, when expenses started spiking because of the inflationary pressures that we saw over the last several years. So that's what we're trying to sort of recover from, is those strains and that stress on the portfolio. And unfortunately, the lower the income households that you were trying to serve, and for Mercy Housing, we're one of the largest nonprofit owners and operators of permanent supportive housing. We're serving some of the most vulnerable, most challenging folks who have a lot of barriers already and need the support. So a couple of things that we've been focused on the last several years include a real emphasis with our site teams and our management teams on just the back to basics, right? We had to really get back to property management basics, getting work orders done, getting back in the units to make sure that we were taking care of deferred maintenance and preventative maintenance work. We had to make sure that our properties were fully staffed. One of the biggest challenges that's still a trailer is the high turnover and vacant positions as people were finding alternate places to go, and our pay needed to keep up with what was happening in the labor market overall. And then a real focus again on making sure we're tracking vacancies, that we're tracking days to turn, we're tracking rent collections. Sadly, we had to get back to evictions. It's just a necessary part of the business, and it really disrupted the typical tenant-landlord relationship. So some of those are back to basic efforts. For us, as we looked at the portfolio, we also started to make sure we were differentiating between family properties, senior properties, permanent supportive housing properties, because we have a pretty diverse portfolio. And we saw less strain in the senior housing, more strain in unsubsidized tax credit properties that serve families. Clearly, families were under more stress with job losses, with health issues, and so forth. So we had to be responsive that way. And then we also had a real focus for us on economic occupancy, just basic numbers, right? Basic industry benchmarks. But you'd be surprised, because of all the other disruptions that were happening, how the site team can sort of lose focus of some of those basics. And what we saw is, across the country, those strains at the property level and at the portfolio level that started really impacting the organizations as we had to feed properties and kind of bridge that disruptive time with our own cash flows, our own subsidizing properties at a higher level than we were used to, right? And a way that wasn't sustainable. So I think we're getting back to all that, back to healthy portfolios, strong property operations, and then finally reinvesting in our people and making sure that the site staff feels appreciated, feels valued, are trained and skilled, and that we're lowering that turnover and vacancy numbers so that we have the right people in the right place to do their job.
Can I add to that?
Absolutely.
Yes, and because all that is really good. What we found post-pandemic in Colorado was people were like, well, I don't have to go into the office. That means I don't have to live in the city. I'm going to go live in some other part of the state. And so we've seen a sprawl to some of our urban areas, which is great. I want to do that too when I grow up. Problem is a lot of those rural communities, they don't have the bandwidth or the infrastructure right now to support that demand on their housing. And so we're finding there's a lot of interest in these small rural communities to develop housing in their communities, but they're not housing developers. So as a housing finance agency, we've strategically placed employees throughout the state. We call them our community relationship managers. These individuals live in community and they represent us in that community, but more importantly, they partner with community leaders to help identify and address some of their affordable housing challenges. In this case, what came from that most recently is our small scale housing innovation program, or technical assistance, where these smaller communities, they want to build housing, they just don't know how to do it. Pro bono will cover the cost for them to get with a housing development professional, teach them that process within their own community, and then at the end, potentially provide them with some pre-development grants. And ultimately, if it's not a development that would qualify for tax credits, we're talking 25 units or less, we would come in as a finance agency and be an equity investor or the long-term debt on that. So really trying to incentivize development in rural communities, support that growth that's happening. I'm just trying to do it in a different way.
Barry, would you like to add to that?
maybe I'll take it in a little bit of a different direction, but I just want to say, I mean, the positive message is we're doing a lot. We want to do more. We were able to do $7 billion of financing last year, and we've been the #1 affordable housing lender for the last 15 years. And that produced about 36,000 units just in our shop alone, which is great. The public-private partnership is just so important, right? I mean, it's the private investors buying the tax credits, the private finance institutions doing the financing, the construction, the permanent, but working with the issuers to use those tax-exempt resources. And that gap financing, which I think depending on where you live, your state, your city, your county, being intentional about raising those resources which are needed to fill the gaps. I'm from Florida. Florida's got a housing trust fund. There have been local governments that have done their own trust funds because they see the need and they know it's not going to all be able to be done on the private side. So they bring those gap fillers to the table. There also have been some private gap fillers that are coming to the table now. There are companies that will buy the land and then lease it back, and that brings down the cost of development. There's been private markets on the tax-exempt side where companies, investors have been willing to get a little bit of a higher interest rate but take a subordinated position in the debt, and that's been able to fill gaps. So you cobble together some good private resources, public resources, and we've got a good affordable housing program that we want to continue to grow and make better.
Can I add one more resource?
Yeah.
So if there are any other states here and want to follow suit, what happened in Colorado was we don't have a housing trust fund, so to speak, but what we have is something called TABOR, the Taxpayer Bill of Rights. And what it does is it limits government growth and spending. So revenues within the state can only increase by a certain amount every year. And so therefore expenditures, because we have to have a balanced budget, can only increase so much. To the extent those tax revenues are in excess of that formulaic calculation, they have to be refunded to the citizens of the state of Colorado, which is great. You file your income tax return in Colorado, you get a credit back. Recently, constituents in the state of Colorado approved Proposition 123, which allows the state to keep some of that excess revenue to fund affordable housing. So it equates to about $300 million a year that we can now take and use as gap filler. We can use it for land banking, concessionary debt, or even equity investments in projects where those gaps are being done. And so, again, that's another way for a state to kind of come in and provide some additional funding outside of just providing tax exemption or what have you.
I want to turn next to the topic of preserving the affordable housing that we already have. What are you guys seeing out there in terms of particularly effective approaches? What's working? And this is for any of you.
I can start.
All right.
All right. So yeah, in Colorado, we need to preserve the affordable housing that we have, given that we're short 100,000 units. What we don't want to do is lose any of the units that are in play right now. So locally, we created what we call our Housing Preservation Network. It's a group of organizations, Enterprise being a member of that locally. And essentially, it's this housing preservation network that gets together and we share information. Really, it's a way of communicating. We've created this housing preservation dashboard, which essentially is a Tableau data visualization tool to show where are all the units that are at risk of losing their affordability. They're at the end of their restricted use period. We want to preserve those, and so we coordinate around which developments are prime and ready to be preserved, and then we allocate resources around that. So we've created an affordable housing preservation fund within the state, albeit small. So if there's any investors in the room who want to invest in that fund, come talk to me. But essentially, it's meant to be a quick strike fund to allow a developer to maybe acquire a property, keep it affordable until they can maybe have it go through re-syndication and get recapitalized with tax credits again. So we're looking at it from that perspective, taking a coordinated approach of identifying those properties and then working to preserve them. We do use sometimes the low-income housing tax credit to preserve those. We're trying to be as efficient with the tax credit as possible. So for those preservation deals, we really are waiting for that particular project to be at the end of its useful life as far as affordability restrictions go, and then we'll prioritize that deal going forward.
Yeah, I'll say that this is an area, interesting, that I think we're actually failing, and I think there are more challenges than there are bright spots when it comes to preservation of existing affordable housing. And despite some great state-level efforts, which are happening, around the country, I think we're still lacking really a national, and this is work that's happening state by state, right? So we're not lacking a national policy level. We're lacking this as a policy priority at a state level. And you see it reflected in most of the QAPs that allocate the tax credits, where they are, for political reasons, often prioritizing production, right, new units over preserving existing units. And we just see it, across the board, state by state, and it's really played out because of how the 4% credits, right, have become competitive, and so now states have to prioritize how they're allocating even the 4% credits as they have the 9s. So it's a real challenge from that perspective, and this is an area where I share from my experience, having previously run the Denver Housing Authority. We saw what happened to the public housing portfolio when we stopped investing in it as a country in a significant way. And unfortunately, I see that the tax credit portfolio, which is huge, right? It is our affordable housing portfolio, is kind of going down that same track where the portfolio is getting older, and we're not finding the best ways to invest in it overall. I would agree with some of the earlier, suggestions, right? That maybe we exempt preservation from the bond cap so that those 4% credits can flow more easily to those. Maybe we continue to build state by state or at a national level some preference for nonprofit ownership, being part of the ownership of these units, because that we tend to ensure longer term holds, longer term affordability, and more stability in that portfolio overall. And then underpinning it all is the need for voucher subsidies, because many of these properties, because they are older, they haven't been kept up as well. It's harder to get rent increases and stay competitive that way. And so the rent subsidies from additional vouchers would help with cash flow to help finance the recapitalization. So I think there's some solutions out there for it, but it definitely has to become a higher policy priority across the states.
Barry, I was wondering if we could talk specifics here. At Citi Community Capital, you guys recently provided loans to purchase and rehab a 240 apartment project in Akron, Ohio. Can you tell us about that and sort of how the housing assistance payment came into that?
Yeah, just kind of echoing the whole notion of the housing assistance payments, or that you're able to get a rent which is at fair market, which in some cases is higher than what that low-income housing tax credit rent would be, and that additional dollar amount helps you have a higher cash flow, which can support additional debt. And with that, you can help raise the dollars that you need, combined with tax credits, to do that rehabilitation and actually make it economically viable.
Perfect. Thomas, moving to you. Colorado recently introduced a pilot program that offers a middle-income housing tax credit for rentals for the missing middle.
Yeah.
Tell us who these people are and what that program looks like.
Yeah, happy to do that. The Colorado legislature recently passed the middle-income housing tax credit, the MITEC. I don't think that's trademarked, but maybe I'll trademark that. So not LITEC, but MITEC. And really what it is to incentivize development within that 80 to 120% area median income range. Mm-hmm. It can go as high as 140% AMI if you're in rural resort communities, I think like the Aspens, Vales, Breckenridges. But it's a 5-year pilot program. It's a 5-year credit that can be taken. The legislature initially allocated $40 million in credits to be awarded between now and 2029. So that roughly equates to, depending on the tax credit equity pricing, anywhere between $150 $200 million in equity that can then go to these multifamily developments. Again, we're trying to target those higher incomes. So this would be a 100% affordable between 80 and 120% AMI. So I know there are deals getting done. I think Montgomery County in Maryland doing one right now where they were able to do a middle income deal, what I would call a middle income deal without tax credits, because they were prioritizing some lower AMIs and mixing it with market rate. In this case, none of these are market rate. These are all going to be below market rate. As far as the first year goes, so this is the first year where we're accepting applications for the program. We received 12 letters of intent from developers, which then led to 5 of those developers submitting full applications. Because it's a small program, 5 years, our first year we only have about $5 million in credit, so about $25 million in equity that we have to award. We're only going to be able to award probably 3 deals. But in this case, we're really trying to show that it will work, so we can go back to our legislature here in a couple weeks, yeah, that'd be nice, a couple years, to get them to reauthorize and expand that housing tax credit.
Yeah, and then the state credits, just to emphasize that, having a state credit program is a great way to help, particularly some of the preservation transactions that when you may not need to have the federal LIHTC, but you can get state credits. We're working on something in New York right now where that's really making it work.
Perfect. I'd like to open it up to audience questions now. If you haven't submitted a question yet, you can do so using the QR code in your program if you're here, or using the link in the YouTube chat if you're watching online. All right, we've got an anonymous question here. Great discussion of the sources needed to finance affordable housing. What about the uses? Are there financing strategies to incentivize lower development costs, for example, through innovative construction methods?
I can take that one if you want. Thanks, Anonymous, for that question. That's a great question. You should put your name on that one.
Yeah.
I don't know if you guys saw a recent Washington Post article about the cost of construction, but it's real out there. So within Colorado, we have a cost dashboard that's on our website. It can show exactly what it's going to cost to develop an affordable tax credit property, and then we compare that to market rate. I heard earlier here today that Colorado is one of the few states that has parity between a tax credit property and a market rate development. So costs we're really trying to keep down by just putting it out there. When people can see what it actually costs, for whatever reason, they find better ways to value engineer and bring that cost down. And so we've seen that. We're also incentivizing the use of modular off-site construction and bringing that on. So the state has made heavy investment in bringing modular manufacturers to the state of Colorado. So think off-site, panelized, 3D print, any of those, mass timber, really trying to incentivize any of those lower cost forms of construction. And then the other piece to that is education. So what we're finding is by having those different technologies come in to bring the cost of construction down, we also need to train our workforce a little bit different. And so we've set up scholarship funds within the major universities in the state to say, if you can teach a new workforce on housing construction, how to stitch these off-site build units together, that will greatly help increase the number of qualified professionals who actually build these things. So that's one thing we're doing in Colorado.
I would just add to that, that this notion of incentivizing through public-private partnerships, meaning the public partners, the cities or state, to help incentivize and create pilot demonstration projects. City of Los Angeles did that we participated in with some other developers to bring modular housing and use modular housing specifically as a way to continue to prove up that concept, that business model, that's a lower cost way to deliver housing cheaper and quicker. Was an example, and I know in Denver, Mayor Johnson is doing a design competition, soliciting ideas and concepts from design build teams on how can we deliver affordable housing at a lower cost. So I think it's an area that's ripe for public partners to help incentivize and create the conditions for that to be for people to take risks, incentivized there.
We have another anonymous question. What can you tell us about limited equity co-ops and community land trusts as mechanisms for innovative affordability? How do we gain momentum?
I can take this one. It says anonymous, but I think I know who asked this question. Sent to him next to him earlier today. But this is something of interest in Colorado. We've seen more equity co-ops come up, and we have I want to say quite a few. We have several really strong community land trust organizations within the state, and we found ways to partner with them. So again, some of that funding that we're going to be receiving from the state that's investing in our bonds, that we're going to then use those proceeds to build homes at a more affordable price point. The idea is that, you know, if you could have a land trust come in and maintain those units affordable for many years, as opposed to just doing it one time and then that unit or that home is no longer affordable, we're looking for ways to partner with them. So again, we're targeting a lower price point, we're targeting a certain income level, and then we're working with the land trusts or the co-ops in the state to maintain that property affordable for in perpetuity.
I think I would add to that, not exactly the land trust model, but what we do often come across and utilize as a way to lower development costs are long-term ground leases. And we do that with partners like hospitals or universities that want to see affordable housing developed in their community and are willing to give you a long-term ground lease rather than sell the land underneath to you as the developer and long-term owner. And so I think long-term ground leases as a way to invite an anchor network partner, an anchor institution, an anchor partner like a hospital or a school district, a university, or the city even, is another good mechanism in a similar way to a land trust that helps lower the costs by taking the cost of the land out of the equation in terms of the total development cost.
All right, and a third question from Anonymous. How do you think about the balance between streamlining financing in increasingly complex capital stacks and funders' desire to set priorities for allocating their limited funds?
Well, I have all this gray hair because of the complexity of these capital stacks. So to the extent that we can make things simpler, I'm always a big proponent of that. I think some of the things that you said earlier, the alignment of different capital sources and when it's available, if you could get on cycles that are similar so that all those sources can come to the table at the same time, that's certainly helpful. Figuring out who's got priority is always a big discussion in a legal exercise. I think it's just more communication amongst the various parties and trying to get to some more systematic ways of doing things together.
I would just add, right, if cost and complexity are what's driving costs up and making it harder to deliver affordable housing, then stability and simplicity is how you get more housing done cheaper. And I do think that includes the stability, the predictability of these other funding sources, besides the tax credit, the predictability of the CDBG home, voucher funding, all that has to be there. Otherwise, you kind of create disruptions in what would normally be a predictable financing strategy. But also to the question specifically, the simplicity or simplifying compliance as an owner, manager. If a resident wants to move into a unit and they have to qualify and do eligibility determinations for 2, 3, 4, or 5 different programs, that really adds cost, complexity, and barriers to entry for the folks who are trying to move in, whether it's move them in from off the street or somebody who's been paying more than 50% of their income for housing, and we have an affordable unit that we want to move that family into. So I would sort of push back a little on the question, and I think that rather than adding more complexity to the transaction, simplifying it by reducing the compliance barriers would be really a win for the whole industry and for all of us trying to work in this space.
I'll just add, in Colorado, we have multiple organizations that fund affordable housing. You have my entity, the State Housing Finance Agency. You have the State Division of Housing. You have the State Office of Economic Development and International Trade that also administers some state funding. You have a middle-income housing authority in the state. We're all trying to address affordable housing issues, but what we've never done really good in the past is coordinate together. And so that's one thing that we're doing now, is we're working to coordinate better. What is our North Star? What are we trying to achieve together? And then communicating that to the development community so they know exactly what it is we want to see and then working to remove some of those barriers as it relates at the local level of permitting and whatnot. And I think our governor's stance on that has been, if you want some of the state funding, you need to fall in line, and we'll make those resources available to you. But as a state, we also have to be more coordinated in what priorities we're setting for the affordable housing development community.
And we have one last question from Lisa Rice. She asks, you touched on the challenges related to higher insurance costs. Can you dig deeper and share more information about how your organizations are working to address this issue? Are you collaborating with your state insurance departments? Are you working to ensure the housing you build or fund is resilient?
So I'll talk about it from, as a developer, owner, manager, I would say. Right, there's two levels to this challenge. One is the operational level. So as a property owner, what can we do to lower insurance costs, premiums, claims, and so forth. But then there are the market issues, the macro level issues, which we can't address individually and really do have to do through coalitions and collaborations. So from a design perspective, there's a lot of things we have learned to do and are doing more of to make our properties more resilient. Whether we're building in California, where there's a high fire danger, or now, in the southeast, Atlanta, Savannah, where freeze warnings and, frost events are becoming a real challenge to pipes, that are not insulated, and other things like that. So we're learning from our claims history. We're learning from the climate change impacts to property ownership and operations about things we can do on site, things we can do in the design that really pay off by lowering the cost of insurance. The bigger issues, the macro issues, are a little more challenging, but that's where we are partnering we've partnered with HUD, we've partnered with our congressional leadership to think about how do we address those issues. And I don't know that there's as many issues or solutions that have really gained traction there. We've seen states try to address it at a state level through state level captives. We've heard talk about, is there a role for the Federal Home Loan Bank to play through their kind of CRA type authority that they have, and knowing that insurance companies go to them for capital, just like the banks do. Is there a role there through a CRA type focus on insurance companies? And there are other solutions, but I don't think we've landed on one. And I think it's going to be a bigger challenge if we're not addressing, the climate change and climate risks that we're really seeing, if we're not addressing that in a real transparent and straightforward way.
That is unfortunately all the time we have. Please join me in thanking this incredible panel. We will now have a short break, and programming will resume in 10 minutes.